Well, hello, my name is Brett Hersh, and I'm an instructor for overnightaccountant.com, and I'm also the owner of HBS Tax and Business Experts, and I'd like to welcome you to our year-end last-minute tax planning for individuals. And I'm sorry this really is last minute. Excuse me. Part of the reason is I got a cold. Other part of the reason is I got that tax bill running through, and I think they're going to vote on it very soon. We're trying to figure out what's in it and get you some good advice. You got about 2 weeks left, so I'm hoping you can use this advice. Remember, informational purposes only. This video does not constitute what? Tax advice. Taxes are complicated. Get a professional if you really need some tax advice. Informational purposes only is what this is. All right, this video. Watch to the end for a discount on any course at overnightaccountant.com that'll help you with your business and your taxes. Watch to the end, get that discount code, visit our website, order a class, learn something. Awesome. This tax plan, what we're going to be discussing in this video is really going to be based on the House and the Senate bills, items that are in common with both bills. It's not law yet, but these are just a few items that are in common. There's really only 2 or 3 that are really going to impact most individuals. We want to go over them planning for 2017. And when I say impact, I mean primarily for planning for 2017. It's not the end of the year yet. They haven't voted on it yet. We're also going to go over some general year-end tax plan to help you reduce your taxes for 2017. The House and Senate bills, we're going to discuss the areas most in common that are likely to pass. Itemized deductions. One result of this bill is you're going to find in the future a lot less folks will be itemizing deductions. You're also going to find that the standard deduction has doubled. That's one of the primary reasons that so many fewer folks are going to be itemizing. You're also going to notice that the increase in some credits, like the child tax credit, is going to increase substantially, and also it's going to be more what we call refundable for future years. So that's good. Big change here, or a big change in the tax code, is the SALT deduction, state and local income taxes, state and local tax deduction. This is going to be, these are reported on Schedule A, state and local taxes. The Senate bill removed the SALT entirely. The House bill, however, removed it all except for $10,000 max on real estate tax deductions. But don't worry, guys, in those high tax states, because the compromise, we believe when they went into compromise in committee, what they're coming out with, which we're pretty sure is going to be coming out, this compromise is going to allow us $10,000 in any combination of taxes. So you're going to get 10 grand. However, it's going to be real estate taxes, income taxes, and or sales tax. It's going to be capped at $10,000. For a lot of folks in a lot of these high tax states, you had your real estate taxes and your income taxes, that state and local. That's better than nothing, but it's not near the deduction you were getting before. So how do you plan for this? Well, of course, what we want you to do is pay as much as you can in the current year because it's still deductible in this year, still fully deductible in this year if you itemize, and that's in 2017. If you're a person that makes estimated state payments, we want you to make a giant estimated state tax payment by the end of 2017 for your 4th quarter of 2017. Even if you don't make it, you still fill out that form and send it in. If you're going to itemize for this year, it'll still help you out. So we want you to make a very large state income tax payment in December of this year. And when you do your taxes for 2017, your state taxes, you're probably going to get a giant refund. Then you're going to apply that refund to 2018. So all you're really doing is paying your state taxes early, and you're getting a deduction for this year. Or you could have it refunded. However, we want this to be a legitimate deduction. Don't just send it in the state claiming the deduction, because it's going to be income to you next year anyways if you get the refund. But this is a good way for you to get the deduction this year, and also you're paying your taxes earlier. Pay your property taxes earlier this year before year end if you can. If you know what it is, maybe you haven't paid, look online. A lot of us there. If you haven't paid yet, pay them up. Get that deduction. Every $100 is going to save you upwards of $30, $40 in taxes. So it's a big deal. All right, here's another big thing for the tax bill. Both House and Senate versions largely remove miscellaneous itemized deductions with very, very few exceptions. Both plans largely eliminate them. This includes items like the bill for your tax preparation, bill for your tax software for an individual. This does not impact any business return. Let me just specify that. This is only on the individual return Schedule A, does not impact Schedule C. All of your business-related expenses are still in there. There's a lot of misinformation out there about that. It does not touch business expenses. This is only your miscellaneous itemized deductions. Unreimbursed employee expenses, that's a big deal. So is the employee home office, or they're both miscellaneous itemized deductions. The House and Senate bills largely eliminate them. So how do you plan for this? If you're an employee, like I know a lot of folks that are drivers, put a lot of miles on their car and they're not reimbursed for those expenses. They do a lot of driving and that's a very large deduction for them and you're not going to have that in the future. So what I want you to do planning for 2017, pay whatever you can this year for 2018 or later. If you can pay things in advance that you know are there, you already have the bills, pay them in advance. It'll help you a little bit in 2017, but what I really want you to do after you watch this video, plant a little seed in your head or put a string on your finger or something, you go talk to your employers about creating an accountable plan for you and other employees that are in the same boat with these unreimbursed expenses. This will allow them to basically, you turn in receipts, you turn in some kind of expense log, your employer pays you for those expenses, it's not income to you, they get to deduct it, you still get a benefit from it, you don't lose the money, it's actually probably better for you, maybe a little worse for the employer, but hey, they want their employees to be happy, right? So talk to them about what is called an accountable reimbursement plan. We may actually have a video on this on overnightaccountant.com on our YouTube page or on our website, so check it out. And like as I said earlier, this is a big deal for many, many folks who have high unreimbursed employee expenses. So we move to the two common things. We're going to have a third one here in a second. Before we get to the general year-end planning, I want to talk to you just for a second. If you're a business owner, both House and Senate bills, and I think they make this retroactive through September or so. I'm not sure on the dates. However, if you can still purchase some equipment by the end of the year, you may want to look into doing that. If you're purchasing a vehicle or whatever, there still may be limits on that. We don't know for sure yet. But however, other equipment, heavy equipment, items you need for your business, you may want to purchase them by the end of the year, enter into a contract, go into debt for them if you're going into debt. I hope you're not. But if you are, that'll help you for 2017. All right, general year-end tax planning. Retirement contributions, 401ks and similar amounts. You get the match from your employer, they're all a good deal. Increase contributions if you can in your final paycheck. Might be hard to do. You may need to talk to HR, your administrator. If you can do it, you may be able to put a big lump sum in there at the end of the year. The reason you want to do that because it might save you 25 to 30% on average on your taxes for 2017. So that's a year-end tip. If you're not really covered by employer plan, if you have a relatively low income to that, check out traditional IRA deductions. And basically that you can make those deductions by the due date of the return without extensions on a traditional IRA. Start planning now, start saving now so you can get that deduction. It'll allow you to put away up to $5,500 per person. If you and your husband and your wife, that's 11 grand. So two folks living together or married, filing jointly. If you're over 50, you get an extra $1,000. That's $6,500 you can put away. Remember, 25-30% savings on that. That's real money. Also, oftentimes you can reduce them on your state taxes. Now, it's also limited by income and other retirement plans that you may have. So you may want to talk to a professional, talk to your whoever you have your brokers through or whoever, or your bank, and see what you can deduct in order to do it. And when you prepare your return, you actually, there's a lot of worksheets that'll show you what you can deduct, what you can't deduct. Charitable contributions, max them out by the end of the year. No drastic change. However, fewer folks are going to itemize. The result's going to be less tax benefit of charitable contributions for many folks in future years. All right, so what you do is contribute what you can before the end of the year. If you are, let's say at church, if you've made a commitment to pay X amount of dollars in the next 2 years or whatever for a building fund, something to that effect, maximize what you can this year. Every dollar you save is going to save you 25-30 cents in taxes. So let's get the deduction this year. This is a good time to go find your receipts. If you have receipts, keep them. Go through your checkbook, see what you can find. This is a good time to just do your planning. Also, Goodwill, Salvation Army, your non-cash charitable contribution items. If you have those items that you give to them, let's say box of books, clothing, that sort of thing, clean out the garage, put them together, take a picture of them, document. But get them to Goodwill, itemize a list of what you gave to them, get the deduction. Very important. I want you to get the deduction. All right, remember you got to give it to a qualified organization. A few notes on charitable contributions. Cash, check, or non-cash. Excuse me, just let you know that cash is no good no more. You've got to have a receipt. You have to have a receipt. Special rules for higher value items and vehicles, getting appraisals, that sort of thing. Just want to make you aware of that. Here's a good tip. If you're over 70 and a half and you have an IRA and you're starting to the point where you're getting required to get what's called required minimum distributions, check out what is called qualified charitable distributions. This basically happens when the payments, you work with your brokers or whoever they may be, the payment goes directly to the charity, the 501c3, the church, or whoever it's going to, It's not income to you. You don't get a deduction, but it's not income. So it's basically you're making a distribution completely tax-free and you're giving it to a good cause. Even if you were to get that cash in and itemize it, it's an itemized deduction. It's not going to reduce your state taxes in many cases. So that's a really good tool. It's a good tool to become more popular. You're over 70 and a half. Check that out. Qualified charitable distributions. Okay, take losses. All right, here's some basic tax tips, okay? Before the end of the year, if you're online, talk to your broker, sell some losing stocks investments. You can deduct up to $3,000 a year to offset gains. If you have some losses that are carried over from prior years, check out your old returns. Oftentimes with Schedule D, folks forget about the loss carryovers. You can have $10,000 carried over from past few years, may not know it. You can sell, the stock market's really high, you can basically sell tax-free 10,000 gains offset by the losses. Woohoo! Tax-free money. We like to have tax-free money. Okay, long-term capital gain taxes have rates of 0 to 15% for most. Or actually, if you even need to sell stuff at a gain, if you're getting a little nervous about where the stock market is, hey, you're gonna get hit with some taxes. But if you've had it for over a year, that's long-term. Tax rate for most is not very high. So defer income. This is very important if you're a business owner right now, and then as part of that tax bill is, depending on the type of business, many service businesses don't qualify for this, we're learning now, but many business owners, Schedule C, partnerships, S corporations, anything with a flow-through income, you may have a 20% deduction on your gross receipts for next year. That's killer. That's a great tax deduction is what it is. And you're going to save 20%. So if you postpone income from this year to next year, guess what? You're going to save some serious bucks. Hopefully. Postpone income if you can. If you're going to be in the same other tax bracket, that's kind of your general year-to-year stuff. This year it's even more important because you're getting that 20% deduction. Bonuses, IRAs, investment sales, whatever you can put off the next year. If you're going to be in the same income tax bracket or lower, defer that income. Providing a service, if you got a contract, maybe you don't want to start that contract yet. You got 2 weeks, start in 2018, not 2017. Don't earn that money till later. Don't bill for your services too late until 2018. Whatever you can do, do it, but do it legally. Remember, pigs get slaughtered. Don't be a pig. All right, holding a check will not work. However, there's certain things you can do to defer income, but if you have constructively received that check or that cash, not putting it in the bank doesn't matter. It's income to you in the year you receive it. Remember that. Okay, 529 plans. This is a great state tax deduction. If it's state sponsored, that's up to $70,000 per child. So if you have kids or grandkids, make that deduction, get the state deduction on it. Just remember, now some of these items, they may have to be your dependent in your state to get that deduction. You may have to check with your individual states. However, $70,000 per child, that's a nice state tax deduction. May have gift tax implications, just want to make you aware of that. Flexible spending accounts, cafeteria plan, basically $2,600. If you have one, you know what it is. $2,600 tax-free, you can set aside for certain uses, dependent care, medical expenses, whatever that may be. It's usually part of the cafeteria plan. Make sure you use them up because at $2,600, it's usually use it or lose it. So if you've got some in that account, you find some way to use that money for something that will qualify for in that cafeteria plan. Don't use it. Don't lose it, use it. December 31st or March 15th, depending on the plans when you lose the funds. Some of them, depending on the plan, can have a carryover to the following year of $500. Still, there's still $2,100 in there. If you ain't spent it, you're going to lose it. It's your money. It's tax-free, but you're going to lose it out of the plan. You're going to benefit from it. All right. You don't want to know. Here's your number one tax tip. All right. I'm going to close this out with the number one tax tip. You know what it is? You know what it is? Are you ready? Are you ready? Don't wait to the end of the year to do your tax planning. If you're watching this video right now, last minute, good for you. We appreciate you watching it. Hey, like our YouTube page. I'm going to say it again, but before I forget, like our YouTube page if you're watching this on YouTube. Thank you. And remember, your discount code's coming up. But don't wait till the end of the year. 2018 is coming up. Got a lot of new tax law changes. It's really an opportunity to plan for the whole year to reduce your largest expense. And that is why we are here at Overnight Accountant to help you do that. Now, get your discount code somewhere on here. Get that code.